Good afternoon, ladies and gentlemen, and welcome to the Trident Royalties PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Adam Davidson. Good afternoon, sir.
Thank you. Good afternoon. I'll just provide a quick introduction and then hand it over to our CFO, Richard Hughes, to chat through the next few slides, and then we'll try to leave ample time for questions at the end. We've had a few that were pre-submitted, so we'll try to make sure we get through as many as we can. For those not very familiar with Trident, we listed on AIM just about 2.5 years ago in June 2020. We'll talk through the strategy in a moment, but when we listed, we had effectively secured one small cash flowing royalty and had a strategy that we thought was very compelling. And when you fast forward to 2.5 years to today, we now have north of 20 assets, a dozen of which are cash flowing. Much broader diversification within the portfolio. And then importantly for shareholders, we listed at 20p a share. And then as of today, we're sort of hovering around 49.50p a share. And I think, as we'll speak to, quite a few catalysts to come, which make for a very compelling investment case. Many of you would have seen our third quarter results, which were published at the beginning of this week. I think very positive outcome, our best quarter yet, quite frankly. We had about 2.4 million in revenue for the quarter, which is our best quarterly revenue when you take into account sort of some one-off events that led to some spikes previous quarters. So very strong sort of revenue profile. But I suppose most importantly from our perspective, yes, 20% plus sort of quarter-over-quarter increase in revenue. But the most exciting thing from our perspective is it's a six-fold increase in revenue from the same quarter last year. And as we'll speak to in some of these slides, we sort of see that growth trajectory continuing just from the assets within our portfolio. And then obviously the objective is to continue to add to that revenue profile. So we're pretty excited about the future with Trident. We're well capitalized. We've got cash to deploy to acquire more assets. I think it's the right market to do so. And then we're very, very excited about the assets within our portfolio and some of the events that we expect to see coming over the next few quarters. So with that, I'll hand it over to Richard, and he'll run through the sort of strategy and some of the next steps we see coming in the portfolio.
Great, thanks, Adam. I think when we look at royalties, they're a pretty unique subsector within the commodity space. I know they're pretty well followed and common in North America. Over here in Europe, they probably get a bit less attention than other parts of the mining sector. Just touching on the advantages of holding royalties and royalty equities, as opposed to buying a mining stock or holding, physical ETFs or even physical commodities. As a royalty co, we still get all the benefits of leverage to commodity prices and, exposure to the strong thematics and fundamentals that I think we all believe in the commodity sector. Again, on the exploration side, when projects we hold royalties over, create some value at the drill bit, extend life, extend assets, our royalty exposure continues with time and grows. So we get all the benefits that you get from holding the mining equity, but we're not exposed to a number of the challenges and risks that, certainly single asset mining companies have. So certainly over the last 2-3 years, we've seen vast cost inflation come through, both within CapEx of trying to build new projects, and also on the operating cost side, which really squeezed margins for a lot of mining businesses. So as a royalty holder, our revenue obviously comes off the top line, so we're not exposed to those pressures. And I think a big problem from a returns perspective for a mining company is that if you're building a project and you are squeezed on the capital cost side, that invariably leads to further dilution for equity shareholders and really drives down returns over time. So we don't have those challenges to deal with. And from a broader perspective, Trident, we're a small company, but even today we have over 20 assets, 12 of those are cash flowing. So an issue at one operation doesn't, impact the business in the same way as it would if we were just building one project, say down in West Africa or somewhere else in the world. And the final benefit of being a royalty holder is we sit in the capital structure, often beneath the senior secured debt, but above the equity holders. So through a cycle, there may be situations where company goes into some difficulties, but the royalty generally remains through that period. So it's a pretty good position to be in. Then when we flip forward and look at the sort of advantages and how they play out, and they can be seen very clearly. So this chart shows the three big North American royalty and streaming companies, Franco, Wheaton, and Royal Gold. And as you can see very clearly, over sort of a 15-year period, they've dramatically outperformed the GDX, which is the North American Gold Producers Index. And that really is just an example of some of those benefits that I was talking about coming out over time as they've built and diversified and reinvested their cash flows and built some very large, low-risk, streams of cash flow spread around a number of the best mining assets in the world. Obviously, they're a number of years ahead of where Trident is, but that just goes to show you, the potential that these type of businesses can have over time. Then just flipping forward and focusing on Trident itself. So I think our approach is slightly different to others in the royalty sector. So if you take a look at the top chart, you can see the mining sector by revenues broadly split into three buckets of base, precious metals, bulk, battery, and industrial materials. And of that whole pie, most of the royalty sector is focused on precious metals. So about 90% of the royalty sector has that focus on what is about a third of the revenue. There's only a very small number of companies focused on the non-precious side. And when you see the breakout pie chart in the bottom right, of that sort of smaller 7%, the bulk of that is single asset iron ore businesses such as Thacker and Labrador Iron. So there's only a few companies really trying to do what we're doing, which is to build a broad-based exposure to the mining sector through royalty instruments. So that's what we're targeting. We're looking at the whole of that top pie chart. So both bulks, base metals, and selectively we'll play in the precious space. Obviously recognize it's pretty competitive, so we're probably not going to outbid some of those big North American companies. So we're happy to look on a very targeted basis. And this is the strategy we've got. And so hopefully over time we can keep building and expanding and build a broad portfolio of royalties across commodity, across jurisdiction, and hopefully generate some pretty attractive returns. So just looking at the strategy to date and how it's played out. When Adam joined the business and started, they had one iron ore royalty. Shift that forward 2 years, the business now has over 20 royalties. As I say, about 12 of those are now cash flowing. And that sort of progressions obviously helped build the share price through a period of pretty choppy, global equity markets and also commodity markets. So that's testament to the business model and the success of the team in acquiring assets, and also benefiting over time from the good news and the development of each of our project companies as they move these projects along the pipeline. So over time, we're always harvesting good news as they develop assets and help bring us nearer to cash flow or increase our cash flow. So that's where we are to date. And obviously the plan is to really continue to build on this base, add more assets and step the platform up to the next level. So with that, I'll just hand back to Adam.
Yep, thanks, Richard. I think with regards to the portfolio, we'd like to spend some time on this webinar going through quite a few of the assets, just to articulate sort of the status of some of them and some of the catalysts that we see forthcoming. Because as mentioned in the intro, there's quite a few exciting things on the horizon for us. I mean, on this slide in particular, you can see the smattering of assets. And I suppose there's kind of two key messages that we want to convey here. One is you can see 63% of our assets on a NAV basis are located in Canada, US, or Australia. So obviously tier one economies. And we really want to keep that proportion. We don't have a fixed proportion in mind, but we're conscious that our shareholders don't want us to become a frontier markets offering. So we'll look almost in any jurisdiction at an asset. Key considerations are obviously political risk. We need to price that into any deal. And then importantly, whether the jurisdiction has the right legal framework to accommodate royalties and the protections that convey with royalties, such as the royalty being conveying with the land such that it can never go away, even in a bankruptcy scenario. That royalty is over that deposit in perpetuity. Those are pretty key considerations for us. So we'll look anywhere, but obviously want to keep a weighting towards developed economies. And then the other thing we would like to flag is there's often a misconception, because we're a junior royalty company, that all of our royalties are predominantly held by junior operators, single asset, small operators that are exposed to single asset risk. And in fact, it's almost the exact opposite that's true. When you look at all of our key royalties, they're predominantly led by mid-tier and majors. So, Thacker Pass, obviously a high priority asset in our portfolio, operated by Lithium Americas, which is a circa $3.5 billion market cap company, has 500+ million in the bank. So a very well established, very financeable operator. Similar with the Sonora royalties, operated by Ganfeng Lithium, and many of our gold assets and others are very high quality operators. Obviously, the royalties are right sized to fit within our portfolio. Otherwise, we'd be a multi-billion-dollar market cap company, and we're not quite there yet. But good operators nonetheless, just right sized for our portfolio, which is a pretty key consideration, because particularly in choppy markets like we're in today, you want to have royalties over assets that will survive the cycles and thrive in the good times in particular. And then just a brief snapshot of the portfolio. What you'll see here is we do look across the development cycle with regards to deploying capital. There's quite a value uplift that can be had from getting a royalty over an earlier stage asset, seeing it add to its resources and reserves, move into study work towards development, and you see a revaluation of that asset as it moves forward. And obviously, acquiring producing assets provides immediate cash flow, which is very, very welcome within the portfolio. Now, the reality is most producing assets, you have to pay more because they are producing and they're materially de-risked relative to something that's earlier stage. So what we found is the sweet spot for our portfolio is typically assets that are kind of 2 to 3 years from first production. I think at that point in time, what you find is they're materially de-risked. The deposit is sort of taken shape, the study work is by and large done, and you've got a pretty good line of sight on the final 2 key hurdles for any project globally, which is permitting and financing of construction. But it's not yet in production, so there's still that value uplift to come. And then with regards to revenue, this is the broker estimates. I think people have seen our revenue thus far in the first couple quarters, so closing in on 10 million for the first 3 quarters. And expecting a strong fourth quarter here as well. But obviously, the most important thing from our perspective is as assets come online, we see exponential growth within the portfolio. And critically for us, this isn't sort of aspirational. This is assets that either are in construction or are very close to commencing construction, such that there's absolute line of sight to this revenue eventuating. And that's a pretty key differentiator, I suppose, between us and investors selecting between a developer that has a project they want to bring online. Is we've got a portfolio of assets that are moving in the right direction, and any one of them can be a major catalyst for us with regards to revenue. And I suppose the final thing for us to flag on this slide is this is the revenue profile we've built for having been listed for less than 2.5 years. Obviously, we're not done yet, so the intent is to continue to build on this profile and have a company that in the not too distant future is spinning out over 100 million a year in revenue, and obviously can support a sustainable dividend, can support low cost debt, can largely self-fund future acquisitions, and that's where we can take a page out of our precious focused peers, because this is a model that has been executed many times before, very successfully. It's just nobody has really done that in the non-precious side of the world yet. So that's what we've been stepping out on. And I think with regards to valuation, there's quite a bit of material out there that people can mull through. But what you've seen this year is obviously we're the best performing royalty company, and a lot of that is driven by the fact that our revenue has stepped up pretty significantly with acquisitions we made last year. So last year's revenue was a touch over 1.5 million. This year's revenue is going to be multiples of that. It already is multiples of that. And royalty companies tend to be valued on their revenue or on cash flow. And the simple fact is it's because royalty companies tend to have so many assets relative to a miner, which may have just a few assets. So you know, rather than investors going out there and trying to analyze every single asset and building up a DCF valuation of every single asset in a sum of parts, what they tend to do is sort of take cash flow and slap it with a multiple, you know, anywhere from sort of 10 to 15 times is kind of industry standard, depending on where we are in commodity cycles and the broader economy. So you slap it with that multiple, and that gives you sort of a relative valuation. And that's what we've seen happen to ourselves this year is our revenue stepped up, our valuation also stepped up. But what it doesn't do is really ascribe any value to those assets that, although they do have clear line of sight to first production, you know, they're not cash flowing as of today. So there's this dislocation where, yes, strong share price performance thus, you know, so far in the year. In fact, in excess of the 22% that's on the screen at this point. But we are trading at a discount to NAV because our NAV is hugely weighted towards some of these assets that are being de-risked and moving towards production. But until that cash flow eventuates, it won't be reflected in our share price. And obviously, that's our job as management to try to shine a light on that and have that value sort of realized as early as we possibly can. But it obviously creates a compelling case for shareholders when the certainty of that cash flow becomes clearer and clearer. Then it's just a matter of time before it's recognized in the share price. And I wanted to touch through just a couple of our assets because there has been a lot of progress across the portfolio. I did mention I'm going to try to save as much time for questions as possible, so I won't drag you guys through every single asset, but just a few of them that have had some pretty material movement, and I think might answer a few of the questions we've had come in. Thacker Pass is obviously a very important asset for us, depending on which broker report you're looking at. Anywhere from circa 25 to 30% of our NAV could probably be allocated towards Thacker Pass. And this was a very compelling investment for us, sort of stepping back so that people get a feel for, you know, I think this asset in particular, but also how we source deals and how we price them internally and how we approach deal making in general. This was held by a closed-end fund that had a fixed fund life. So couldn't really hold the asset until it's in first production because they have a period at which they have to exit. So we knew of the existence of this royalty. In fact, it was written over 10 years ago. That the kind of key issues for us were we wanted to see clarity on permitting and we wanted to see clarity on financing of construction. And I think we got that in January of 2021, whereby the operator Lithium Americas received their final key federal permit, which is undergoing the final challenge now, which I'll talk to more in a moment. And then later that week, Lithium Americas raised $400 million in an oversubscribed equity raise, predominantly towards construction of Thacker Pass. So you got a very well capitalized operator, very, very easy access to capital from their perspective, and then very good line of sight on finalization of the permit. And so it's a compelling investment case in that this is one of the largest global lithium deposits in the world, the largest one in the U.S. certainly, and the most advanced. The U.S. doesn't really produce much domestic lithium, but growth is obviously exponential, and it's not just aspirational at this stage. You know, we're seeing it eventuate. The U.S. is getting its lithium predominantly from Australia and South America. A lot of it goes via Korea for processing, but there's particularly in this macro environment that we're in today, there's a huge push to have security of supply of critical minerals, and lithium is at the very, very top of that list. So I think we anticipate this moving forward into construction next year. And you know, when we priced the deal, lithium was obviously not where it is today. It was sort of in the teens with regards to price per ton. So we priced it accordingly. We used $12,000 per ton lithium price, and the PFS stage production profile, and we were pricing in a 16% post-tax IRR. So a very, very sort of compelling investment case upon acquisition, but with the knowledge that there's quite a bit of upside baked into that deal. And indeed, we've seen some of that eventuate in that. And subsequent to acquiring the royalty, the operator increased the planned production profile by a third. So that alone bumped up our base case IRR to circa 20+% on a post-tax basis. So very, very compelling. And then on top of that, lithium's obviously not at $12,000 per ton. It's, as of today, sort of around $75,000 per ton. And you know, I don't expect that it's going to stay there in perpetuity. It just shows the sort of compelling revenue profile that can convey with an asset like this. In the waterfall chart that you see on this slide, you can see the expected cash flow once stage 2 of the project is fully ramped up. And then you add to that the production expansion that was announced after we acquired the royalty. And then I think anecdotally, we used $50,000 per ton lithium here. Pick your number, but at $50,000 per ton lithium, this royalty would be paying us 45 million, circa 45 million a year once fully ramped up. And it's got a 46-year mine life, resource that's doubled since we bought it, and could underpin an extension of that mine life or further production profile expansion. So just a very, very compelling investment case. And we've had a couple questions. The permit's going through its final hearing. This is a pretty standard process in the U.S. from a permitting perspective, and we've got a lot of experience in U.S. project permitting. So effectively, the final hearing is now set for January 5th. We would expect the judge's ruling to come, several months hopefully after that. She said on a couple occasions publicly that she wants to expedite a decision on the merits of the case. So, our hope is that before the end of Q1, that would give sort of a full 3 months from the final hearing for her to come out with her decision. But certainly in H1 next year, it's our expectation that this permit will be finalized. And Lithium Americas has made no secret of the fact that immediately upon the permit being finalized, they're going to commence construction, and they're funded to do so. So I think some pretty exciting things to come on this asset, and a massive de-risking event for us. So we would expect that to be reflected in the share price at the time. We did want to touch on the Sonora lithium royalty. I think it's slightly opaque maybe to the market and not fully appreciated for what it is. We've got a right to fund the acquisition of an indirect 1.5% gross revenue royalty. Sonora is not hugely dissimilar from Thacker Pass. It's an America's lithium project. In many respects, actually, it's a little bit more advanced than Thacker Pass, in that its pilot plant's been running for about 5 years now. Again, Fang, the operator, acquired the full project early this year or late last year, and just recently flagged that it is in construction. They want to accelerate construction. And similar to Thacker Pass, they've also expanded the planned production profile, most significantly at the stage 2, which they increased by 43% to 50,000 tons of lithium hydroxide. And the hydroxide typically trades at a slight premium to carbonate. So it's sort of a similar, you're probably picking up on the theme here, that when you acquire royalty over a good asset being led by a well-funded operator, you can see value eventuate that isn't baked into the royalty at acquisition. And effectively, things like project expansions are paid for by the shareholders of that company. That's capital that they have to put into the project rather than returning to shareholders, and yet we get to benefit from it. So again, we priced this one at sort of a low to mid-teens post-tax IRR, again, using $12,000 per ton lithium. And when you use closer to spot prices on this one, plus the expansion, then we see this one could pay north of 50 million. So it's pretty material with regards to revenue. It's on par with Thacker Pass effectively. The reason I say it's probably not quite been recognized by the market is because we haven't yet acquired the royalty. The royalty's in litigation, in that it was challenged. The validity of the royalty was challenged, saying that it shouldn't have been issued effectively. The estate that holds the royalty today won the first court battle, effectively won on a statute of limitations ruling that said that the challenge should have been presented within the first 2 years, which is Alberta law. So the final hearing, the appeal, is also in January, similar to Thacker Pass. Decision on that could take a little bit longer, but expect that one in H1 2023. And that's a pretty material event, again, for us, because once that's cleared and we have certainty on any other sort of key risks to the asset, most particularly any sort of rumblings about Mexican nationalization, which we're not hugely concerned about, but want some certainty there before exercising our right to go in there and fund the acquisition. So that's effectively sort of a synthetic option that we're holding open, and has huge value once it's de-risked in the appropriate way. So pretty excited about that asset, and as mentioned, we see it coming into cash flow probably a touch sooner than Thacker Pass. So, as we stand today, I mentioned that we're effectively being valued on our revenue today, but you can see what happens if these two assets move in the right direction, and we don't have to wait very long before we get certainty on these assets. So it's a pretty exciting position for the company. I've spoken obviously quite a bit on lithium. Wanted to touch on at least one other asset that's had some good news lately within our portfolio, and that's the Mimbula copper project. as some of the longer term shareholders may recall, we did this deal shortly after listing in mid 2020. And it's been a good royalty for us. Effectively, it was the first royalty that we didn't acquire secondhand. We wrote the royalty directly with the company and provided them $5 million in capital. As part of that, we put in a minimum payment schedule because we knew there would be a lag from providing the capital to first production. So the minimum payment schedule is paying us $500,000 a quarter US this year. That steps up to $750,000 a quarter for the first 2 quarters next year. And then at that point, we've recovered our $5 million. The royalty rate steps down to 0.3%, and then it sort of runs in perpetuity. And this is actually dovetailed perfectly in that we just announced recently that the operator Mashika Resources is imminently. In fact, they may have just recently produced their first copper cathode, but it's due within days in any case from their stage 1 production profile of 10,000 tons a year. And then they've published a study in August to ramp up production to stage 2, which would be 56,000 tons of copper per year. So a pretty significant size project. You can see the scale in that photo. Copper is obviously a metal that we're very keen to get more exposure to. We think this is a really high quality asset. I think the structure of the royalty was done right, such that by middle of next year, effectively from a deployed capital perspective, we're off risk. And then we've got this full mine life to get exposure to that asset. And look no further than the fact that this year alone, the operator raised $85 million in equity placement, and then $150 million in an offtake financing with the tier 1 offtaker. $50 million of that has been drawn. So just very well financed, moving in the right direction. A private company. So we've got less that we can sort of put out there in the public domain, but moving very much in the right direction. So we're very excited about the progress there as well. I've articulated some of these, so I won't drag you through them again. But I think you look across our portfolio, and there's quite a bit of exciting news flow with regards to some of the assets. We put out an announcement recently on Los Filos. Equinox Gold published a study relating to an expansion of Los Filos, over which we have an offtake of 50% of their gold produced. It's a very high quality mine, good economics, and would love to see it expanded as soon as they clear their FID to fund the expansion. But again, across the portfolio, a number of positive catalysts. And then, of course, there's the new transactions. As I mentioned, there's a lot of exciting stuff happening within the portfolio, but we've only been listed a little over 2 years. The idea is that we're continuing to deploy capital and continue to add new projects, new commodities to the portfolio. And on that basis, we're pretty confident in the future. We've got north of $20 million in cash in the bank. We have the Macquarie facility, the debt facility, which is fully drawn, but Macquarie had never backed a royalty company to date, and did so with the express intent of looking to expand that facility. If we revert to them with good leverageable deals, then we can, between debt, the balance sheet cash we're generating, the ability to use paper for existing royalties, which we've done frequently. There's quite a few levers within our capacity here to expand the portfolio while managing dilution. We're all equity incentivized, so we want to ensure that we don't grow but have the share price stay where it's at. That's not in anybody's interest. But I think we're in the right environment effectively to add to the portfolio. As Richard mentioned, it's a choppy environment, so we want to be careful and focus on, I guess, quality, sustainable operations. So we're sifting through a large number of opportunities. I think as operators are starting to really feel the pain with the markets turning, we're going to see more opportunities. And in fact, we have seen that just pick up over the last few months. So we do fully expect to be deploying more capital here over the next few quarters and continuing to build out the portfolio. So we're pretty excited about some of the potential there. The final bit before I turn to Q&A then is just a quick snapshot of our register. I think one thing to flag is you can see some of our major shareholders. Again, for those long-suffering shareholders of ours, when we started, you saw it was primarily resources-focused funds, or in some cases mining-specific focused funds. But now we're getting sort of more the generalists, the Amadis, the BlackRocks of the world getting on the register. More UK-focused institutions, more generalists. Quite a few that are just below that sort of 3% reporting threshold, and actually a couple that had to get waivers on their market cap minimum to be able to deploy capital into TRIDENT. So I think quite a few groups taking good toehold positions, like the direction of travel, and want to be in a position to support us. So we're seeing the right transition that we needed to see with regards to the register. And then, as mentioned, a strong cash balance, I think a manageable debt position. We're conscious of dilution. I always like to flag the options package sitting within the company, and that management's very much incentivized by equity. I think unlike many companies that you've probably come across whereby the equity's sort of priced at spot or maybe a slight uptick to spot, our options package is predominantly priced in equal tranches from 80p to £1.20. We've got to get the share price to those levels, hold them there for a year before they then effectively vest. And the strike price for that large options package is 50p. So upon vesting, they're in the money, which is a great incentive for us. But importantly for us, we don't sort of see that incentive unless we're delivering for shareholders and delivering in a significant way. So I think that's an important thing to flag. And then the final thing is, obviously, as we've grown, we've been picked up more and more by research analysts. You can see the target prices there, but and Liberum was the most recent to pick us up with regards to research. Has a 75p price target that they recently increased, and is not an appointed broker of Trident. So I think we're starting to get a bit more visibility, I suppose, in the UK market. And with that, I think we've got plenty of time now to pivot to questions.
Adam, absolutely, and Richard as well. Thank you very much indeed for your presentation this afternoon. If I may, I will just bring back up your cameras. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Richard, Adam, as you can see in the Q&A tab, we have received a number of questions throughout today's presentation. So thank you to everyone on the call for taking the time to submit their questions. And if I could just hand back to you to address those where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Perfect. Thanks. Yep, we'll run through these. I think the first one we have here is, would you consider investing in resources such as graphite, potash, or rare earths? Are there any assets you would regard as off limits? I think the quick answer to that one is we'd certainly look at graphite, potash, and rare earths. In fact, we have looked at all three. As you can imagine, each have their sort of unique characteristics. And it really comes back to what I said earlier. We want royalties over very defensible assets. And what you find in some of these commodities mentioned there's quite a break between the existing assets with regards to grade and quality of deposit, and then some of the development assets. So we just want to make sure that we're being very pragmatic, and we don't want to have royalties over what would be a swing producer. And when times are good, they're making money. When times are bad, they're shutting down. So we're sensitive to that. But to answer the broader question, yeah, we're certainly looking at those commodities and would happily have exposure within the portfolio. I think it's actually very important to do so. The next one here is for Richard specifically. Richard, what attracted you most to joining the business, and what are your key priorities for the next 6 to 12 months?
Great, thanks, Adam. Well, in my sort of previous career in bank, it's been about 15 years, and a lot of that time I was working with some of the other royalty companies in the sector, and then as an independent consultant, again, continued that sort of flow of work with some of the other groups based here in London. So I know the royalty and streaming sector well, and as we chatted about earlier, I think it's a really exciting part of the market. It offers a lot of growth and a lot of opportunity, but also much lower risk than, say, even from a work perspective, if you're working for a single asset junior. So I really buy into the model, and I think Trident are very well positioned with the catalysts around the 2 or 3 big assets they've already got in the pipeline going forward. So I think it's a great opportunity to work in a business that's well set up with a good team. I think for me, the next 6 to 12 months, it's about executing on that pipeline, and hopefully putting a number of new assets onto the books. And as we do that, we can hopefully transition and both grow and reduce the cost of our debt facility. And as we increase our access to capital and reduce its cost over that time.
Perfect, thank you. Next one we have is there's been a lack of new royalty contracts after a fast start. Is this a financing issue or timing in the sense of an unstable geopolitical market? I suppose there's a few things. I suppose the way we approach it is there's a time to deploy capital and there's a time not to. Markets were pretty hot and pretty challenging sort of this time last year and even trickling into the early part of this year. So probably not the ideal time to be deploying capital. And then as we've gotten into this year, it's obviously a very dynamic market out there, and it really comes back to wanting royalties over high quality assets. The few I touched on, that's the type of exposure we want in the portfolio. There's no shortage of royalties out there in the world. In fact, you can look at some of our peers in terms of gobbling up assets all over the world. You could quickly build up a portfolio of north of 50 royalties, but 40 of them may have de minimis value. So I think we want to pragmatically grow the portfolio on a very accretive basis. As I mentioned, we're all equity incentivized. So we want to see the share price grow. Scale for the sake of scale doesn't do anything for anybody in this company. So we're focused on doing high quality transactions and just approaching it in a very pragmatic way. And I touched on it earlier. I think we're moving into a period where we suspect there will be good opportunity to deploy capital. We're sifting through a large number of opportunities and suspect that we've got a few that are advancing, which we'd hope would get there over the next sort of quarter or two. And then just from a practical perspective too, there have been quite a number of deals we've been working on that just didn't get there. So, there's a bit of ebb and flow with regards to just executing on transactions in many cases outside of our control, but we keep plugging away at it. And it's obviously our day job and our number one priority is to add to the portfolio in an accretive manner. So I'm not worried in the slightest about pipeline. I think, to answer part of the question, it's not a financing issue. I think when we first listed, financing was always a bit of a question mark. Will the market respond the right way? But our last equity raise was at 36p. We're now sort of around 50p. So the share price is moving in the right direction. As mentioned, we feel comfortable with our access to debt. We feel comfortable we can lower our cost of debt as we go. Our script clearly has value. So when third parties that have royalties want to vend them into Trident, there's a discussion to be had there on whether they take cash or shares. So I think there's quite a few levers, and we're in a better position than we've probably ever been with regards to ability to finance transactions. Given your reasonable financial expectations, when do you expect to commence the payment of dividends? Richard, maybe I'll let you tackle this one.
Great, thanks, Adam. Yeah, I think dividends are important, certainly in the medium term. But I think as we look at our capital allocation, at the moment, there's a lot of opportunities to deploy capital and to grow. And I think that's the first priority. And I think as some of the assets do build up, over the next couple of years, I think dividends will certainly become part of the puzzle. But I'd say in the short term, growth is the focus.
Yeah. Let's see. The next one we have is any thoughts, plans regarding tin and/or tungsten? Those are two commodities we've looked at, and actually we've got pretty deep expertise internally, both on tin and tungsten. I haven't done much personally on tungsten. One of my colleagues has done quite a bit, but I've done quite a bit on tin. In fact, I've been to tin mines and smelters everywhere from Peru, Brazil, Indonesia, Malaysia, Australia. So very I like the compelling supply-demand dynamic of tin. It's a key part. It's a solder that holds all electronics together. So it's a key part of electrification. And yet supply is increasingly constrained. Quite a bit of it came out of Myanmar, which is sort of a no-go zone at the moment. And some of the historic key producers of tin, the likes of Indonesia, for example, whereas before, they were onshore mining inland. You see less and less of that now. And then it moved offshore. Many years ago, moved offshore. And you'd see the cutter suction dredges just offshore. Now they're off over the horizon because the materials have just been mined and the grades are dropping. And it's the natural sort of as these areas are mined out. There's not been a real dearth of new supply to replace them. So I like the supply-demand dynamic specifically on tin. For us, then it's just a matter of getting exposure to good quality assets, because a lot of the tin developers are relatively low grade. And I'd like to get exposure, ideally, to the full sort of tin value chain, because I think that's where a lot of the value lies, is not just the mining of tin, but sort of some of the downstream functions within that value chain. So anyway, long-winded way of saying yes, very, very excited about tin. And if our colleague Thacker was on, he'd be able to talk to the same depth on tungsten, but have looked at and will continue to look at opportunities in both commodities. Let's see. I think that's about it for questions. One question was there any further color on the on the 5th January Court Appeals hearing on Thacker Pass. I think I broadly touched on this. We don't have any info that's sort of not out there in the public domain, obviously. The hearing is scheduled for January 5th. From there, the judge, it's really with her to make her final decision. As mentioned, she's stated on several occasions publicly that she wants to expedite a decision. So our expectation is that we would see a decision ideally within first quarter. So hopefully that's what happens. Certainly within the first half of next year, the expectation is that decision will be finalized. And then from there, in terms of permitting process, there can be subsequent appeals, but the bar is raised very significantly such that there has to be massive gross negligence for a subsequent appeal to overturn this finalization of the permit. Something catastrophically wrong. In fact, if they commence construction and something happens subsequently, then the government has to refund the operator to sort of put everything back where they found it, so to speak, and cease the project. So the onus is really on the government at that point in time. But this is a scenario that's been very, very rare. In fact, I can't think of very many examples where it's ever occurred. So really, the expectation is once this decision is made, and hopefully it's in the right direction, then the project commences construction, permitting's behind us, and then it's just looking forward to the cash flow from there. One thing worth flagging as well is obviously as part of our royalty, there's a partial buyback that the operator can exercise. And the way the royalty structures, it's on a 100% basis, an 8% gross revenue royalty, which is a pretty egregious royalty load. It was structured that way such that the operator is sort of almost forced to exercise the buyback. So what we expect to happen, and what Lithium America's study work has always indicated they would do, is that prior to first production, they would exercise that buyback, which reduces the royalty down from 8% to 1.75. We would hold 1.05% of that. So the numbers I was flagging at stage 2, circa 45 million in annual revenue at $50,000 per ton lithium price, that was on the assumption that buyback is executed. And that buyback to us would be 13.2 million. So effectively, that would mean we'd be on risk with regards to deployed capital at 14.8 million. And have that sort of revenue profile for, as mentioned, a 46-year mine life, and every ample opportunity for it to extend its life beyond that. So pretty compelling returns. And I think what we'd like to do is to see if we couldn't pull forward that buyback. We'd be open to accepting a discount, but pulling forward that buyback such that we have the capital, which we can then turn around and redeploy elsewhere. It looks like our final question is, placings are now generally perceived as being against the interest of private shareholders and favoring institutions. How might you deal with this come many future placings? Hopefully it's not many future placings. I think, as mentioned, we're pretty protective of our share capital. The key way we have protected against this, and you may have seen the last 2 capital raisings we did, we always did a primary bid retail offering such that retail investors can participate alongside the institutions on the same basis as the institution. So there's no sort of special treatment for the institutions. You can come in on the same terms. In fact, when I look at our raises, the IPO was at 20p, and then our next raise was at 34p, and that was effectively to fund the acquisition of the Thacker Pass royalty. We did a primary bid, which was well taken up on. And that equity raise was effectively done at no discount. So we weren't out there sort of offering hefty discounts to institutions to participate. The next raise, there was a slight discount, but well below sort of standard market rates. And again, we did a primary bid offering such that retail could participate alongside. But what you haven't seen us do is go out there and do sort of a placement only to an institution at a 10% discount to spot price. That's not in our interest and not the way we want to manage this company. Final question, it looks like. Can you expand on the Sonora legal issues? To do it in a very succinct way, I guess the royalty was issued to a former MD of the operator at the time, Bacanora. There were some reasons why it was issued to him, but and then it was subsequently challenged by Bacanora as saying that they shouldn't have issued him that royalty. He subsequently passed away, so it's sitting with his estate. And the initial ruling, as I mentioned, was on statute of limitations. So it doesn't really get into the merits of the case. It's really just, Alberta law. This is governed by Alberta law in Canada. You've got 2 years to raise a challenge like that. It wasn't done within that 2-year time frame. So the estate won. Now the appeal being heard in January is an appeal on that basis. The advice we've gotten, for what it's worth, is that it's typically hard to win appeals in general, and then it's very hard to win appeals when it's really on sort of almost an administrative type point, like a statute of limitations. It's hard to overturn a ruling like that in appeal. But we'll see next year effectively. The way we structure the deals, we put down a deposit effectively of $2.5 million. If it is ruled against the estate, then we get that deposit back and it's fully collateralized. But if they win the appeal, then we have that right to fund. If we choose not to for some reason at that point in time, then there's a $250,000 break fee. So a pretty manageable break fee for an asset of that size and quality. But it'd be our expectation that we'd want to acquire that royalty. So that's and we've got until January 2025, or 6 months after first royalty payment has been made on the project, in which to exercise our right. But we'd be looking to bring that asset within the portfolio once we think that it's been adequately de-risked.
Adam, Richard, if I may just jump back in there, and thank you very much indeed for being so generous of your time there and addressing every question that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, and then add any additional responses where it's appropriate to do so. Adam, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, of course. Well, I want to thank people for attending. Appreciate your interest in what we're doing. We think we've got a very exciting company here with some very clear, exciting catalysts on the horizon, which is not the case for many companies who've been able to weather the storm over the last sort of 6 to 9 months here in the markets. And in fact, we've seen our share price increase over the course of this year. So we're pretty excited that we're going to continue that trend and have a number of transactions in addition to the catalysts within the portfolio that we'd like to see eventuate over the next sort of 2 to 3 quarters. So yeah, appreciate people joining. Follow us on Twitter. We publish a lot on our website. Feel free to reach out to me. My email address is on our website. I answer all shareholder inquiries. Happy to have phone calls as well. So we want to keep up a dialogue with shareholders as much as possible. And to one of the questions on retail investors being allowed to participate alongside institutional investors, we also want to keep retail investors as informed as institutional investors. It's very important to us. So please follow us closely, and please reach out if you have any questions.
Adam, that's great. And Richard as well, thank you once again for taking the time to update investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of TRIDENT Royalties PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.